Is inflation the painful medicine the global economy needs? Welcome to the Real Vision Daily Briefing. It's Thursday, November 3rd, 2022. I'm Ash Bennington. I'm joined today by Vincent Deluard, Director of Global Macro Strategy at StoneX. Our Real Vision audience, of course, knows him as one of the first inflationistas. Lots to talk about today. Before we get started, a quick reminder, our live chat function on the Real Vision site is temporarily disabled. Please drop your questions in the comment section on the Real Vision website, in the live chat on YouTube, or on Twitter at Real Vision. Vincent, welcome back to Real Vision.
Pleasure to be here, my friend. Good to be
Well,
here.
we have you here in a pretty wild time. It's been a busy 24 hours. Yesterday, the Fed hiked 75 basis points. Fed funds rate moving from 375, moving to 375 to 400 as the target range. During the news conference, Chair Powell advised the window for a soft landing on the economy is narrowing. Today, Bank of England hike 75%, its largest increase since 1989. Rates moving from 2.25% to 3%. Moreover, the BOE warning of the longest recession since records have been kept. The cost of living rising at the fastest pace in 40 years. A whole lot happening on the central bank front, a whole lot happening on the macro front. Vincent, how do you frame it all in your head?
Well, I mean, I've been in the inflation is more resilient and higher for longer camp. So obviously, I thought yesterday's press conference was great. He was on point. He was clear. He needed to, I think the problem is the market. It's like a child who needs to be constantly reminded of the same message. And that's what he had to do again yesterday. It's just going to be, have to stop believing in fairy tales like this dovish pivot. This is not something that the Fed ever suggested was going to happen. There's nothing in the data, at least at this point, that suggests that it should happen. We'll see. Maybe in a year, maybe the economy does slow, maybe something breaks. But
so the fairy tale you're talking about, for people who haven't been following this as closely as you have, was this notion that the Fed was going to either decelerate the hiking pace or even cut. That was the rumor a few months ago. It seems as though the data has basically said, nope, that's not possible, Chair Powell. How do you think about that and the market reaction that we've seen?
Yeah, I think there's a lot of data to support Powell's hawkishness. You look at the job opening data. I mean, you had a big drop and then bounced back up. You look at the Atlanta Fed GP nowcast is actually pretty high, around 3%. Cleveland Fed forecast for inflation is at 8.1. You look at average hourly earnings, they're growing by about 5.5%. If you narrow it down to people who are switching jobs, which is a very important, most important number, right? Because that's what we've seen is great resignation process, is that workers are switching jobs to get pay raises. That's up, record high of 7.2%, I think. So, I mean, we'll see what the non-farm payroll number is on Friday, but my expectation is that it's going to be above 200. And if that's the case, yeah, labor market is not cooling down. Right now, the Fed is a single mandate central bank. And I think he's just going to have to repeat that until the market gets the memo that, now we're still hiking. So let's not, get over our skis and start pricing cuts that may not happen.
It's a single mandate central bank with problems on both sides of the dual mandate. That's the challenge. And this is very consistent with your view of the risks of stagflation. One more data point that I wanted to throw in there, PCE, this is the Fed's preferred measure of inflation. So PCE for September, 6.2%. PCE ex food and energy, this is so-called core PCE, 5.1%, significantly above the 2% rate, the 2% target that they're anchored to.
Yeah, and I thought one part that was interesting during the press conference is that a journalist, I forget who it was, Brian McGee, I can't remember now. I asked him about the lag in the core PCE and in the way the Fed computes shelter, and I keep getting that on Twitter as well, and I hate that. It's like, yes, I understand how the Fed computes PCE and how the Fed computes shelter, and that there's a built-in lag in rents that feeds into the OER. So that's one of the
This is the owner equivalent rent that you're referring
Right,
to
right.
here,
The
the way the
dovish
Fed
pivot
prices out.
argument is that basically the Fed is driving, looking at the rearview mirror, over tighten because it is not capturing the fall in real estate prices in real time. What I find funny about that argument first is that no one was making that argument a year ago when real estate prices were rising by 30% year over year.
Right.
And at the end of the day, the CPI is not a buffet. It's not a pick and choose your item. Powell had said, I'm looking at core PCE, and I think he gave a pretty strong answer on rents and shelter. And yeah, that's going to keep rising. I mean, there's a tremendous momentum and inertia in these measures. Your core PCE is basically shelter and wages, and both of these things, wages are rising by 5-6%, and then shelter is you're looking at 0.5, 0.6 month on the month, and that's going to keep happening until late 2023. So that really throws off the timing on rate cuts.
By the way, in terms of late 2023, which you just referenced, I'm looking right now on Bloomberg at the world interest rate probability. This is the swaps that price out interest rates going forward. As we said, of course, up 75 basis points, 375 to 400 basis points right now. Going forward into September of 2023, implied rate over 5%.
Yeah. Well, that is the jump from yesterday, right?
Yeah.
I think before the Fed meeting we were at 4.9, and now we're about 5, and then that's consistent with what he said about revising the terminal rate higher and maybe sticking with this longer. I think one message that I think is important from yesterday's meeting is maybe the de-emphasize the whether it's 75 or 50 doesn't really matter, the size of each individual hike.
Right.
What he stressed upon, which I think is kind of important, is that he's going to keep at it until he sees significant progress on the inflation front.
This was the language that they added in the statement about the cumulative rate rise, this idea of trying to de-emphasize whether it's 50 basis points, 75 basis points on any particular meeting.
Which is kind of funny that initially when the statement came out, the market viewed that as dovish.
Yeah.
Oh, we were thinking about the cumulative impact because we've done so much hiking already, maybe we're over. That was the exact opposite interpretation that he suggested at the press conference, basically that, we may not do 75, but we're going to keep doing 25, and there is no hard limit at 5. And I don't think there ever was a hard limit at 5. I mean, this is something, again, something that the market kind of wanted to believe.
Yeah. Well, by the way, talking about things the market wanted to believe and the way that this is being perceived, I wanted to take a look at our tweet of the day. This coming from our CEO and co-founder, Raoul Pal. It's a great tweet. I just want to read this for folks who are listening to this as a podcast. Well, it seems that the beating shall continue until morale improves. Basically, that means liquidity needs to change at the margin, or we need actual confirmation of the collapse in the forward-looking data. Ho hum, nothing to do but wait.
Yeah, I mean, I think that's an accurate description of what happened. And again, I like the phrasing, the beating shall continue until the morale improves. That is the goal. And he said that so earlier, that's why I've been bearish on risk assets all year long. Is all you had to listen was the January press conference said, I want tighter financial conditions. That's Fed speak for lower stock prices. And every time, the hope springs eternal, right? We've seen in the summer that this ridiculous rally we had this summer, in the crypto, the AMC, the Bed Bath and Beyond, the view that the Fed funds rate would peak at 3.3%, or it just kept clubbering on it. Like, rallies are self-defeating because every time we have a rally, that basically gives Powell permission to either be more hawkish or deliver greater rate cut. So in my mind, we move from a world where we had the Fed put, and that's been well tested since 1998, and the bailout of LTCM. Every time the stock market dropped, the Fed would intervene, and the reason it could do that is because there was an inflation problem, right? So it could pursue asset prices as a policy objective. And now we have a Fed call because we have inflation. Every time asset markets rally, financial condition ease, and the Fed has to tighten again. So we went from having a long put below us to having a short call above us.
By the way, talking of hope springs eternal, hope may spring eternal, but the business cycle does not. A trinity of stories out today that seem pretty grim to me. Amazon has expanded its hiring pause. This is a freeze now at the corporate level. Lyft has just announced cuts to its workforce of 13%. Stripe, this of course the online payments company, has just announced layoffs of 14% of its workforce.
Well, and I mean, sure, I don't want to minimize the pain for the people who are going to lose their job. It's always very sad, but let's put that in perspective compared to the insane hiring binge that these big tech companies had in 2020, 2021. I mean, I'm talking from San Francisco here. A lot of friends work in big tech companies, senior managers at Google. They told me they could not do their jobs last year because all they were doing was interviewing candidates, and they had these insane growth targets. Oh, you got to double that team in 2 months. So yeah, we are seeing cuts in tech, but it's just a tip. It's just a fraction of what they hired. I mean, our audience is probably familiar with the TikTok product manager, video that, hey, I'm 21-year-old and I'm all pretty and I'm a product manager at LinkedIn, and I do my yoga in the morning and then I go to the nap room and then I eat free food all day long. I mean, that's not a rare instance. I mean, you really had a massive amount of overhiring in tech, and we're just undoing that. But as far as the inflation story, to me, that's somewhat irrelevant. I mean, these were very unproductive employees to start with. That funny thing with Twitter, right? You can fire 50% of the company. So you're not really changing much, and the shortages that we have are not overpaid 25-year-old product managers working in a fancy office or from home. The shortages we have are truck drivers, farmers. Right. Construction is going to take care of itself, I guess. Restoration, hospitality, and I really doubt that these a 25-year-old product manager making 200 grand a year for going to yoga 3 times a day are gonna revert where the jobs are actually needed.
Yeah, well, I can assure our viewers of this: Real Vision definitely does not have a nap room, and there's no free yoga. But I wanted to, talk about your medium-term outlook here for 2023 as we head in from both the inflation perspective, but also in terms of the expansion of the economy perspective, whether or not you see, I know that you have this stagflationary view, how significant a recession you have in your view.
I am not very obsessed with GDP. What's my output? I write research note or an institutional brokerage. I mean, how do you measure whether my output is greater or less? What's your output? I think once we have a very service-dominated economy, measuring GDP is a lot harder. Like GDP initially was built after the war, and to measure the war effort, how many steel bars are we producing, how many cars, that kind of made sense. But now measuring GDP is very hard. So that's why breaking down what is productivity, what is inflation, what is growth, real growth is very difficult. So to me, the more relevant question is whether consumption demand is going to slow in as much as the Fed hopes and the market hopes. And my answer would be no. I think we're going to have a very strong consumer, a very tight labor market for quite some time. And of course, that's going to go in the way of the Fed's plan for rapid disinflation. As far as GDP, I mean, GDP will do what GDP does. I don't know. My base case is that, we have lower productivity as a whole. And so far, that's what it seems to be, right? Because basically GDP is flat over 1 year, and we're adding about 250,000 jobs a month, right? So, I mean, we have more people to produce the same amount or slightly less. So probably there is a drop in productivity. I can think of good reasons for that to happen. I think COVID is just a tax on the economy, deglobalization, issues with supply chains, mental health issues, the labor force in bad shape. So I could really see productivity be lower. But again, that kind of brings back to this fundamental idea where we could see a decoupling between output and inflation. So let's say GDP drops by 2%, but let's say that productivity drops by 3%, which, by the way, is where we are today, and we have like negative productivity. Well, it will still require 1% more people to produce that smaller output. So that means that your recession doesn't cure your labor market problem, which doesn't cure your inflation problem, which gets me back to the whole stagflation idea, so repeat of the 70s.
Vincent, one of the reasons we like you so much as a guest is that you're not just able to do the broad philosophical context and understanding of this, but you're able to get very pragmatic and tactical. You've got a holy trinity here. Your 3 picks for the year: XLE, XLV, and XLF. These are the select sector spiders for energy, healthcare, and financials. Walk us through that view.
Well, so it started off a quant model that we built for some of our institutional clients, where we're looking at a kind of a growth at a reasonable price type of factoring fundamentals, technicals, and really for 2 years now, energy has been the top sector, which of course has helped returns tremendously. Then healthcare, and then the new one that popped up this year was financial. And if you just did a 1/3, 1/3, 1/3 each, very simple, equal weighted of these 3 sectors, you'd be up about 7% for the year, when the market is down about 25. So why?
And that's overwhelmingly the growth on XLE on energy.
Right, but discrete outperformance from healthcare as well. Healthcare has never been like, energy's been, basically energy and tech are like tug of war, right? These are the ones this, but discreetly you see healthcare creep up because it's defensive. So I think it's the second or third best performing sector, and then financials had a pretty good couple of months. We've seen very solid earnings from the big banks. So yeah, energy has been the big contributor, but I think it's really, you have to understand the way I built it is kind of as a triangle. And you have to think of pretty much every correction we had this year has either been about inflation, recession, or rate hikes, right? These are the Caribbean Silla, I don't know what the third one would be, Bermuda Triangle of risks: recession, rate hikes, and inflation. So what you do with this Trinity portfolio is you hedge each and every one of these risks. If you have inflation surprise, your energy is going to be the best performing sector. If you have fears about recession, healthcare is going to be the best performing, not utilities, by the way. Over time, healthcare is a better defensive bet than utilities, especially now that we are seeing, higher rates. So utilities, to me, are like this bonds with a ton of operational risk. So healthcare protects you against recession, energy against inflation, and then financials are the only sector with positive correlation with a 10-year yield. So as yields rise, the only sector that as well is financial. So whatever happens, you always have a third of your portfolio in the best performing sector. And this is why the drawdowns on this portfolio have been very limited. In the beginning of the year, it was all about energy. Then in the summer, we started freaking out about recession. So healthcare started doing better. And now it seems to me that, rate hikes is the big fear. To me, the big risk of 2023 is going to be curve steepening. Basically, the story of 2022.
Could you say that one more time? I think you're
curve steepening.
Yeah.
So the story of 2022 was we had to price about 500 basis points of hikes. Whoa, but that was mostly in the front, right? I mean, the long end hasn't moved as much. We have these inverted yield curves. If I'm right, we're getting close to the end, right? I mean, 3 or 4, 50 bips hike, and we'll be at that 5.2 that the market is looking at. So then, if I'm right about inflation being more persistent, then your long end is going to have to move up. Maybe 5, certainly 5% is very possible in 10 years, 6, no problem, I think. And then you see these steeper curves, which for banks is wonderful, right? Because they're net interest margin go up, they borrow short, they lend long.
By the way, we should say, for folks who aren't following this as closely as you are, 2s10s curves inverted right now 50 basis points as we have this conversation. I also wanted to touch on something that you pointed out, because I think it's such an important point. You talk about the tug of war between energy and IT. We have a chart. This is actually from today's Bloomberg IMAP GICS sector SPX performance chart, and it's pretty staggering to look at this difference in performance. For those who are listening to this on podcast, I'll just describe what we're seeing here. Energy on the day up 2%, information technology on the day minus 3%. These huge spreads, these huge sectoral divergence between these two sort of opposite poles of equity right now.
Yeah, one by the way, one reason to expect more of of this divergence is EPS. So right now, the market expects energy earnings to drop by 20% next year, while it expects tech and communication services. You know how they broke the tech sector between tech and which I think is kind of silly, but whatever. Between the two of them, they expect
this is the realignment of the GICS chart mechanism, just basically separate out telecom from modern information technology.
Yeah. Anyway, so they expect this, basically the big tech, right? Your Facebook, Apple, Google, Microsoft to grow earnings by 15% next year. While energy earnings are expected to decline by 20%. And if there's one thing I've learned about analyst estimates is you always want to fade, right? And it's always, when the target's low, you can beat, and when the target's too high, that's when you underperform. We certainly saw that in this earnings season with tech earnings or communication service earnings that were low. And it's kind of hard for me to imagine. I don't understand the logic of this. Basically, what the market is telling us is that you won't be able to afford $6 a gallon, but you'll still be able to buy, 20 different subscription to Netflix, Hulu, HBO, whatever, and that you'll be buying an $80,000 Tesla. To me, if really we have like so much economic pain that people can't fill up their tank, a lot of this tech spending will go before we touch to the actual essential.
By the way, talking of energy, I wanted to take a look at a clip. This is from a show today. Give me just 1 second. I want to set this clip up properly. This is Andreas Steno Larsen speaking with Maggie Lake on the Essential Tier today. Make or break, the energy crisis. Is complacency better than crisis? Let's take a look at the clip.
But in a base case, we should be sufficiently covered for this winter season. I think the key question is the next winter season. And I think that was kind of what everybody missed in the discussion earlier this summer, that throughout the early spring and over the summer, Europe was actually able to tap the natural gas resources from Russia to a very large extent. We need to remember that Russia basically closed the Nord Stream pipelines towards the very end of the summer, right? Which was sort of also the peak crisis moment in European energy space. So next year, we don't have those Russian flows to rely on. And usually Russia delivers in between 40 and 45% of the entire natural gas consumption in Europe. Right now, we've probably replaced in between 40 and 45% again of that flow with liquid natural gas, but we still need to replace the other half of that Russian natural gas flow with something else.
So Andreas's base case is sufficient energy supply for Europe this winter, but considerably more concerns heading into next winter. Vincent, does that accord with your view?
Well, the first thing I want to say about Andreas is just give him kudos on that call. There was a lot of gloom and doom about the nat gas market in Europe. Prices would go parabolic, people would freeze to death, and he was consistently on the other side of that and took tremendous abuse on Twitter for it, and so I hope he enjoys his moment now. Now, as far as like the broader meaning, I'm not so sure. I mean, because this is a regional phenomenon, and in general, like oil is a global market, nat gas is a regional market, so you can have like market dislocation in some place of the world without that impacting the rest of the world. I mean, for the longest time, we had the opposite situation where we had very low nat gas prices in New York, especially in the Northeast, because a lot of the gas was stranded. So until you can move, gas as quickly as you can move oil, which is impossible, that I don't think that will matter all that much for energy profits. And he still points, I think, at the end of the interview to what I think is the big issue is, okay, we'll be fine. We're going to be okay this winter, but what about the next one? I think we have this structurally undersupplied energy market that is a result of years of underinvestment, misguided policies, especially in Europe, and now we're kind of balancing it, but very artificially. We're balancing it with releasing 8 million barrels a week from the SPR by having actual energy rationing in Europe. Most places in Europe you're not allowed to raise the thermostat above 19 degrees, and you don't take the car. And then of course we have this hidden cuts in China from the rolling lockdowns. So all in all, that probably removes 4 million barrels a day in oil demand. But we don't really have the supply for that. So at some point, we'll run out of SPR. China will probably reopen, and the weather will get cold in Europe. So one of my dark horse scenario in my most recent report for Sonex was, what if we have an energy shock in December? Because if you look at all these disinflation scenarios, the hope that, okay, inflation is going to slow down by March, because March is the 1-year anniversary of the war in Ukraine, right? So right now we have about 30% base effect in gasoline prices that's dragging the CPI harder. But then after March, that will drop after the trailing 12-month window. So we should see disinflation. What if something else happens? And then you can really kiss your dovish people goodbye. And if we see inflation actually pick up, because right now everybody's arguing about the speed of the disinflation. Even I, I'm fine. I believe 9.1 was the peak for the cycle. But if we have a bad surprise, let's say something bad happens December, we have new sanctions coming on Russia from EU and Japan. We could see, I guess the question is, what's going to happen first? Is the Fed going to pivot first, or is China going to reopen first? If China reopens, we could see. I mean, oil prices are very. I mean, we look at 89. We're close to 90. I mean, if we cross that $100 bar, I think we could see that's. I mean, that's not my baseline, but that is a pretty nasty scenario, because that means the CPI would effectively go back up instead of down.
It's an important counter case and an important open question. And as you point out, most people are talking about the rate of disinflation right now. Unfortunately, we're running out of time here, but I wanted to get in one very quick question, if we could, from FattyMan44 on Twitter. This is an interesting one. Are emerging markets uninvestable until DXY breaks? He's, of course, referring to dollar index, trading right now almost exactly 113, 112 spot 99. Are emerging markets uninvestable with Dixie this high?
Hells no. The MSCI emerging market may be uninvestable, because the MSCI emerging market is massively skewed by 3 big markets, which are China, South Korea, and Taiwan. And they are suffering from the Chinese lockdown, the tech sell-off, and all these things. But if you actually think of true emerging markets, places like Mexico, places like Brazil. I mean, I was in Brazil last week. I mean, Brazil has real rates of 7%. Meaning the Selic, the central bank's rate is 7% above inflation. They're actually looking at rate cuts. GDP is growing. You actually have a fantastic emerging market story under the cover. Now, don't look for it in China. Look for it in Latin America. Brazil is the best example. Then Mexico. Then I look at Chile, Peru. And then if you wanted some Asian exposure, India has actually held up remarkably well. Indonesia, quiet success story. It's up for the year. The bonds are up for the year. Inflation is very low. So you do have kind of an emerging market revival that's happening under the hood, but you don't see it in the index, because the index is all about, the big China tech, and then Taiwan semiconductor, which is getting hammered.
The emerging market revival under the hood. I'm glad we were able to get that question in. Vincent, fantastic to have you here. I want to just throw out some key takeaways for our audience. Inflation is the solution in Vincent's view. Inflation is the tough medicine that the economy needs to take in order to stabilize. His view broadly is stagflationary. Rate hikes is the big story, of course, and curve steepening is the theme that he sees coming up next. By the way, I thought very interesting point that you made, this notion about how GDP is progressively harder to measure in a services economy. Vincent, did I do it any justice? Anything you'd like to add?
No, wonderful. And just remember, Holy Trinity: energy, financials, healthcare. If you did that this year, you'd be up. And I think if you do that next year, you'll certainly be better off than buying a 60-40 portfolio, which is quite broken in my view.
Vincent Delegard, thank you so much for joining us. This was a pleasure.